For more than half a century, Luxembourg has been a centre of excellence for international and cross-border financial services. Having flourished alongside European integration and the common European market, Luxembourg today acts as an EU hub and competence centre to the world's leading financial institutions. Catering to the needs of global investors, the financial centre provides a unique combination of international expertise, a complete toolbox of investment products, and highly specialised financial institutions and service providers. From wealth management, treasury and corporate banking to fund services, banks in Luxembourg have specialised in serving clients across borders. In Europe's leading fund centre, asset managers find the perfect ecosystem to launch and distribute funds to investors across the world. Luxembourg's insurance industry has decades of experience in developing solutions to meet the needs of highly mobile citizens and multinational companies. Centre for international debt listings, securitisation and post-trade services, Luxembourg is the right place for companies to finance their global activities. English-speaking regulators and administrations, access to a multilingual and highly skilled workforce, a AAA-rated stable economy, an innovation-friendly digital nation, an international business environment right in the heart of the European continent. Luxembourg provides the ideal environment for international banks, asset managers and insurance companies to thrive within the European Union and beyond. Grow beyond borders. Luxembourg.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning, good afternoon, or good evening, ladies and gentlemen, and thank you for joining us at our latest live stream event, this time on the topic of pensions. Over 350 of you join us today, from Japan all the way to Brazil and in between. So I hope that this event is both enlightening and interesting for you. Before we go forward, I do need to take cognizance of the fact that all the speakers who join us here today are men. LFF is committed to gender diversity in panel makeup, and of course we will continue to make efforts to ensure equal gender representation in our events, podcasts and publication lineups as a whole. Now, pension funds stand at a pivotal moment. Portfolios have been hit by wild swings in asset valuations, sustained low or even negative interest rates in certain cases are causing many to shift into riskier investments. Rising unemployment in many regions has led to a pressure on both their liquidity and their funding base. Further, a possible rise in inflation, given the fiscal stimulus that is required by the COVID-19 crisis, could see real benefits for members fall in the future. On top of this, aging populations, as well as falling birth rates in some regions, mean that pension funds are needing to do more with less. However, it's not all doom and gloom, as we will surely hear today. Increasing cross-border mobility means we're seeing the rise of new and innovative pension products like the PEPP, which are making it easier to strengthen that all-important third pillar. At the same time, a number of pension funds are increasingly looking beyond their borders, searching for returns to sustain their growth by diversifying into foreign assets. Pension funds' ability to make long-term investments, their long-term investment horizon, also allows for a smoothing of certain risks and market fluctuations. When we look forward, it's important to note that pension funds play a critical role in financing economic growth, and therefore it's up to us to ensure that they remain strong. This leads me quite nicely into introducing our first speaker for the day, Fausto Parente. Fausto is the Executive Director of EIOPA, the European Insurance and Occupational Pensions Authority. He's currently serving a second 5-year term in this role, having been re-elected by EIOPA's board in September last year. Prior to this, Fausto served as the head of Supervisory Regulation and Policy Directorate at the Italian Insurance Supervisor. Fausto, it's great to have you with us, and I give you the floor.
Ladies and gentlemen, thank you. Thank you for the invitation. Thank you for inviting me to talk about stronger pension in Europe. This is really an important topic, and we need to give the right attention to the topic. Close to 20% of the European citizens are at risk of poverty or social exclusion in the older age. So without action, this figure can only get worse. And yet the pension topic is not so popular for discussion. Let's be frank. Nobody wants to hear that they will have to wait longer to receive a pension from their government, from their system, national system. Nobody wants to hear that the occupational pension in which they paid for so many years might not provide the adequate income for the retirement, and nobody wants to really be told, especially in this period of crisis, that they need to save more on a personal basis to afford an adequate retirement period. But while it's a difficult conversation, is one worth having anyway. And today I want to share with you some of the initiative EIOPA is working on to foster a stronger pension in Europe. First point I want to mention is the developing of pension dashboard. However we choose to tackle the pension gap, the information, the right and efficient and complete information will be at the heart of our action. The pension landscape varies considerably among member states, different model, different level of participation, but still information is key on the sustainability and the adequacy of each and every country system. Having the right information, the government can really detect better how the emerging gaps in their system is coming. Already today, some government put together some projection for the public pension, but there are not really so many that have a full picture of also the non-public sources for the retirement income. To close the pension gap, we believe that the three pillars are necessary: state pension, workplace pension, and also private pension. That's why by the end of this year, EIOPA will provide advice on how to develop a pension dashboard that will help monitoring the pension develop in the different member states. Our advice will include the data point, the data needed, how to source it to provide a full picture of the occupational and also personal pension system. With this information, we believe that the government will have an updated view on the progress made towards adequate and sustainable pension. Second initiative I want to mention is the pension tracking system. It's again, the right information are needed. No, we also always need to have in mind information is key. People with the right information, they can be allowed to, they can be put in a position to make the best decision on how they want to live in the retirement period. If we provide people with needs to be simple and easy to understand the overview of their expected retirement income from all the sources, then this will be it will allow people, it will make it easier for them to adequately plan for their retirement. This we want to make sure that this is really easy for them to find the right information. We know that many times people only the idea to search for the adequate figures to make a calculation is complex, and they even maybe not give a try. We want to develop a digital pension tracking system that provides clear, concise, complete information to people. With the help of a network of experts that was set up, and also trying to make use of the already existing best practices, we will map the functional feature of a tracking tool, including how to best present the information, because people need to understand them, also identifying the data point needed, and as I said, the relevant sources. We also want to make this national tracking system to work with the European tracking system, because as also Jonathan mentioned, moving the country for work is a fact of life nowadays, and many people, we want them to really not be bored about the how to reconcile the different national system in which they work during their life. If we can create an easy-to-use tracking system that provides people with comprehensive information, then I'm sure we will be able to engage people with their retirement planning and encourage them to take action if they see some shortfall in their pension adequacy. Third initiative, strengthening the EIOPA. We know that occupational pension play a key role in helping people save for retirement. These days, the trend is really towards defined contribution schemes with the risk shifted to member, and this is to stay, let's say. So it's important that people have confidence, have trust in the entities that manage their pension. This is one of the objectives of the EIOPA directive to strengthen pension fund governance and risk management, and to improve transparency to gain further trust and confidence. And this year, we want to start preparatory work to explore the improvements needed to this directive in view of the already scheduled review of the directive in the coming years. For example, on an area like cross-border business, how to ease, to facilitate, to further push for cross-border activities to also reach more economy of scale. This will be in our plan for this year. But it's also, I also want to mention that it's not enough to simply offer an occupational pension scheme. People need to participate into the scheme. Trust is for sure helping them to participate, but we also need to find more ways to encourage people to become enrolled in good quality pension. And this year, next year actually, EIOPA will initiate some work to provide guidance on how to define an adequate, good quality and sustainable DC pension. Also taking lessons from the design of the PEPP that we Jonathan also mentioned. We worked on it, and let me try to mention that as a last point, the pan-European pension product. Here, I really need to say that it's now becoming a reality. We have spoken about the PEPP for long in the past, but now is really becoming a reality. We provided all the relevant piece of advice, work. Now the second level of regulation is in place. So this is becoming really a reality. And we believe that the basic PEPP will really tick many boxes for consumers. The default investment option has some risk mitigation technique to outperform inflation. It comes with a cost cap, as you know, which makes the product cost effective. Was not our initial thinking to put a cap, but is there now, and it comes as a really cost-effective product to also further encourage people to save. We also worked on the information to be given, the KID. This is designed for the digital age, so it's really, we believe now the PEPP has really the potential to become a game changer, providing consumer with the alternative, sustainable way to save for retirement. The only, really, we are encouraging government around Europe to consider an appropriate tax treatment, because this can further push for the development of an efficient product. So in conclusion, simplicity, transparency, engagement, these are the three factors that are behind all the initiative I mentioned. Because as I said at the beginning, talking about pension is often hard and boring to hear. It's true that the pensions are complex, but it's our job to make the conversation easier. And we believe that by using a more than communication tool, by making the effort to understand how consumer wants to receive the information and being more and more transparent, we can start to make the conversation, if not really enjoyable, but at least less threatening. So we must use all the tools we have at our hands to encourage people to engage with their saving plan. We made a start with introducing the pension benefit statement, including our model that is used around Europe as a benchmark. And also on the KID that I mentioned, the annual statement for the PEPP and the KID are information designed for the digital era, easy to understand and easy consumer friendly, let me say so. So it's really a long journey to achieve a stronger pension in Europe, but the positive news here that we have started and then we are on the right track. And I believe that continuing in this way, we can really add the value for our consumer and help contributing to close the pension gap. Thanks a lot for hearing. Thanks a lot for the invitation. And now I pass the floor back to Jonathan. Thanks a lot, Jonathan.
Well, Fausto, thank you very much for taking the time to share those initiatives with us. I think it's very important that we're part way in this journey, but it is an important one as we look to ensure that as few as possible individuals risk poverty in their old age. It's also clear that we need all participants, be it policymakers, pensions and financial services, as well as the citizens, to take part in this journey. I'm now very happy to hand over to Claude Kremer. He is a founding partner of Arendt and Medernach, as well as a former chairman of both EFAMA and ALFI. He will be moderating a panel discussion on PEPP and international pension funds in practice. Stay tuned.
Good morning, ladies and gentlemen, and welcome to our panel on PEPPs and international pension funds. As we all know, state pensions are the main current source of retirement benefit for most of the people in most of the world, but state pensions face a big challenge. A big challenge because they are unfunded. They are, as we would say, pay as you go, which means that workers fund the pension benefits of retirees, typically through payroll taxes. Now, the population is aging because we have lower birth rates, we have higher longevity, and that means that the number of workers per retiree has declined. And so there is a risk for future retirees that they do not have money enough to finance their pensions. Today, pay-as-you-go pension systems play more and more a subordinated role, and conversely funded pension systems have become more and more popular. They are of two kinds. The first one is what we call defined benefit pensions, who provide financial promises to their beneficiaries, for example, annuities. They in turn face difficulties as their long-term promises cannot easily be adjusted, and the assets backing those promises may lose money. The second category is the defined contribution arrangements, in which there is a direct link between contributions, assets accumulated, and pension benefits. The recently created PEPP, which is an acronym for Pan-European Personal Pension Product, is a funded defined contribution pension product designed as a European tool for third pillar personal pension arrangements. The objective is to create an EU single market for personal pensions. Now, the current PEPP is the result of an ongoing discussion between the European policy makers and regulators and the representatives of the asset management and insurance industry for close to 10 years. And as you can well imagine, the asset management industry has played a significant role through EFAMA, because the asset management industry has a vested interest in the PEPP becoming a success. Why is that? Well, because the pension assets will be invested in collective investment schemes or in individual institutional mandates, and the asset managers are particularly skilled in doing that and to play a role in the development of the PEPP. The first level 1 PEPP regulation was adopted in June 2019, followed by a level 2 regulation adopted in December 2020, which is coming into force in a year's time. And to discuss the current state of the PEPP regulation and its real perspectives in the future, I have the pleasure to welcome a set of experts around this table who have all played a significant role in the elaboration of the PEPP regulation. Now, in the alphabetical order, I will start by introducing Bernard Delbecque, who is well known, a senior director for economics and research at EFAMA. He is the chair of EIOPA's Occupational Pension Stakeholder Group and has been at EFAMA the person who's been driving the project for many, many years. The second panelist is Christian Lemaire, also well known in the industry, former global head of retirement solutions at Amundi and currently board member of the Amundi Pension Fund, a pan-European defined contribution pension fund registered in Luxembourg. He's also a member of the EIOPA stakeholder group. And the last panelist is Martin Parks, also a well-known figure in the industry. Martin is a member of BlackRock's Global Public Policy Group based in London. He is chair of the UK Investment Association's International and European Policy Committee and has also been closely involved in the EFAMA negotiations for the PEPP project. They will cover several topics over the next 45 minutes, which we hope will give you the salient points which you all need to know about PEPPs, and which will give you an insight into a very complex but highly significant project in the international funds sector in Europe. So without further ado, let me jump to the first topic which I will ask you to address, and that is, what is PEPP in a nutshell. We all appreciate that the audience is composed of people who know the industry, who know many things about the regulatory developments, but this is a very technical topic. And to better understand the scope of all this, we thought that it would be a good idea to give you the most significant points of the PEPP regulation. So starting with Bernard, then moving to Martin, and then over to Christian. Please go ahead.
Thank you, Claude. As you said, in many respects, I mean, the PEPP is simple to describe. This is a personal pensions product, and the idea is to offer EU citizens an additional option to save for retirement on a voluntary basis. But would like just to give some background on the objective behind the creation of the PEPP to understand, let's say, the benefit that the PEPP will bring to European citizens and to the European economy. The goal is to solve some of the problems experienced today in the market for personal pensions in Europe. This market is fragmented and organized around national or behind national borders. The cost of personal pensions product is high. The choice offered to citizens is limited and mostly concentrated on insurance products. And these products are not portable from one provider to another, and for sure, from one country to another. So the ambition of the PEPP, the vision of the European Commission, which we share in the asset management industry, is to offer a solution to this problem. How? First, the PEPP will have European passport, like the UCITS. And this will give providers the possibility to offer the same PEPP throughout the EU, and therefore to generate economies of scale. Second, the PEPP, as you said, Claude, will be offered by not only by insurers, but also by banks, by pension funds, and by asset managers. Naturally, this will provide savers with a greater choice of product, which will be less expensive than the existing personal pensions product because of the competition between providers. And third, the PEPP will be portable, and this will allow savers to move across borders without the need to change product. Now, another key features of the PEPP regulation is that it requires PEPP providers to offer a so-called basic PEPP, which will be the version of the PEPP that consumers are likely to choose if they have difficulty making a choice between different investment strategies, because the contribution will need to be invested according to an investment strategies. And the basic PEPP is like the default option for those who have difficulties to choose what is the best strategy for them. What is interesting is that in its initial proposal, the European Commission argued that the basic PEPP should take the form of a guaranteed product. And with EFAMA, with our members, we strongly disagree with this proposal, because an obligation to provide a financial guarantee would have had two major drawbacks. First, these would have de facto limited the access of the PEPP market to insurers. And secondly, all basic PEPP would yield very low returns because the assets would be invested in government bonds and short-term securities. And this would have gone against the goal of the Capital Markets Union to foster investment in equity and increase growth. So we managed to convince the co-legislator, the European Parliament and the Council, to allow the basic PEPP to be based either on a financial guarantee for those who are risk-averse and don't want to take any risk, or on a life cycling investment strategy. And just to be a little bit technical, but I think this is just a major step forward, that no life cycling strategy that are typically offered by fund managers, including under the form of a UCITS. I'd like just to say that under those strategies, most assets are invested in equities, and this makes sense for younger PEPP savers. And there is a switching mechanism to increase the proportion invested in fixed income asset as the saver approach retirement. And this concept, this strategy, ensure higher return for most of the accumulation years and a reduction in exposure to market volatility shortly before retirement. The co-legislator understood that life cycling strategies offer more benefit to consumer than guaranteed insurance product. And numerous academic studies have highlighted this point. So this is a major step forward. And I could, of course, mention other benefit to savers, but I think I will stop here and leave the floor to Martin and Christian.
Yep. Thank you, Bernard. A couple more characteristics to understand about the PEP that came through in the legislative process. Firstly, it comes with an obligation to provide advice. There's an understanding that this is an innovative product and that consumers need support in deciding whether to choose this product for themselves, especially when there may well be competition from competing national products. This doesn't come without its issues, and we'll come back on some of those, but it's an important level of consumer protection. Another level of consumer protection that has been brought through is a disclosure document. So we're all very familiar with the UCITS KID or the PRIPS KID. The PEP decided not to adopt the same format. Instead, it's been looking forward to what is increasingly the digital age and has a document which is far more interactive, which is layered and is far more consumer focused in terms of taking information that is useful to distributors out of the pure consumer document. So there's some very interesting developments on the PEP, which will I think follow through into other areas of financial services. And finally, it's also worth noting that while you have investment choices set out in the PEP, what happens when you come to retirement is very flexible. And that very much reflects national tax rules and national rules. So the way you draw down your benefits on retirement can be quite varied. You can either buy a lump sum, you can buy an annuity, or you can remain invested and draw down income. Christian, I'm sure you have other elements you'd like to add as well.
Thank you, Claude, Bernard, and Martin. I think you mostly covered everything. I just want to wrap up by saying that I think the product has been designed to really answer the main challenges that Claude mentioned at the beginning. It has, first of all, to be able to provide positive net return after inflation, because as Bernard said, when you design adequate life cycle strategies, you can get expected return much higher than inflation at retirement, with a very, very high probability of capital preservation. Also, as Martin said, the fact that you have quite a good way to report information in a digital world is important, because we know that people are a little bit lost, and we really need to foster a kind of financial education. And also the fact that you include flexible payout options are very important, because as Claude mentioned at the beginning, people are living longer. So the decumulation phase after the accumulation phase is more and more important. So that will be my first comment, but obviously we will come back on all these items in the minutes to come.
Thank you very much. I think this is a very good introduction to the topic, and it covers what the objective has been to give birth to this PEP. Now, when I look at the discussions which have been taking place between European policymakers and the Commission, for example, and European regulators, then it occurs to me that there have been two important challenges which have not been really overcome. And that is, on the one hand, this 1% fee cap on the basic PEPP. And the second one is, what about tax harmonization? And will that not be an impediment on the future success of the product? And so I'd like to take these 2 points one after the other and have your views on maybe the reasons why this couldn't be overcome, the consequences of this not having been overcome, and the solutions for the future if we won't be able to overcome that in a second round. So let's start with the fee cap. And Christian, could you give us, for the benefit of the audience, a summary of what that limitation is all about?
Yes, thank you, Claude. First of all, regulators wanted, I think, to have a kind of a maximum level of fees. And on one side, we can understand that obviously, in order to offer good value for money, it's important to obviously have reasonable fees. This 1% cap includes all fees except for the cost of a formal guarantee on capital, which should be proposed mostly by insurers. Just to repeat, to come back to what Bernard just said, it's important to understand that the basic PEPP, because it relates to the basic PEPP, this 1% fee cap, has been designed as a safe product and is the default option. So the original regulation did not require a personal advice before its subscription. However, during the vote at the European Parliament, deputies decided to require advice for all PEPs, including the basic PEP, the basic ones. So, and it's important to understand that this mandatory personal advice, providers will have to review not only the financial objectives and the risk profile of each potential subscriber, but also his or her individual pension entitlements. And all of these imply a long questionnaire, more than 100 questions, face-to-face discussions, and back and forth exchanges with these potential subscribers to collect, check, and analyze all needed information. And this extensive advice will translate into cost that we unfortunately estimate on average much higher than the fees you can get with this 1% fee cap. And interestingly enough, this concern was mentioned by the chairman of EIOPA in his cover letter to the European Commission. And obviously, the PEPP regulation includes other investment options than the basic PEPP. But based on the experience, we have around 3/4 of the subscribers which should take the default option. So it's a big issue, because if we cannot find a viable business model, you can imagine that most providers will keep on selling local pension product. It will be very counterproductive. So it's a big concern.
Thank you, Christian. Martin, what is your perspective on this tricky matter?
A couple of additional points to add to what Christian said. we're all keen on making sure that we provide cost-effective value products that perform over time. But in order to make the economics of the product work, a lot of what we want to do is focus on building scale. And that is what the product offers by you have to offer the product in a minimum at least 2 countries. And the Commission's wish is to offer it as a multi-jurisdictional product. And so operating at scale means you really want to benefit from pooling services. That's pooling the investments, which we can do. That allows you to manage costs effectively. Also, pooling the administration platforms as effectively as possible. But then when you come to this third element of advice, because the framework for the advice is so individualized, and looking at all the requirements, as Christian said, you are ending up providing a very bespoke service on top. And naturally, the more bespoke the service, the higher the cost is. And this is a little bit strange, because you could see that bespoke service being useful certainly later in life as you acquire assets. But when you come into the workplace, and really your strong capital is your own human capital, your social capital as an employer, but your actual assets are quite low. Having a far more simplified process of a decision tree would be, I think, a far more effective way of providing support without necessarily overburdening the product with these additional costs. But I will say, the PEPP, this is the first start. And we need to have these discussions about how we effectively support different types of consumers throughout their journey. But think away of how we can commoditize the support without loading it down with bespoke costs.
Thank you, Martin. Bernard, I know that EFAMA has been very vocal, acting kind of as a spokesperson vis-à-vis the European regulator and the Commission in that topic. What could you add to what has been said before you? Bernard, we can't hear you very well.
Yes, sorry, I was on mute. So I'd like just to add a bit of background. The fee cap was introduced at the very end of the negotiation at the request of the European Parliament, which was prepared to quit the negotiating table if its request was rejected. The European Commission tried to avoid the outcome without success. And this outcome reflects a major shortcoming in the way EU legislation is being developed. I mean, in general, the Commission's proposal is prepared on the basis of a thorough impact assessment, but the final version of directive or regulation is often very significantly different from the Commission proposal because of the amendments of the Parliament and the Council. And those amendments and the impact are not properly assessed. And this is what happened with the fee cap at the very last hour. And a fee cap, and this is recognized also by the OECD, is too blunt a tool to regulate the market. I mean, if the cap is too high, the price of the product tends to rise to the level of the cap, and this is not good for consumers. And if the cap is too low, this discourages providers from offering the product or focusing on the quality of the product. So this is a major issue, and as my colleague said, these may prevent most, if not all, potential providers from, offering a PEPP in the short term. At EFAMA, we try to break this deadlock, and we propose to exclude initial cost of advice. Initial cost of advice, the cost linked to this advice that needs to be provided to prospective savers. And we said, let's exclude it until the first review of the fee cap. Let's make this cost very explicit so that the consumer would just understand, what he's paying, and so that he could compare between different providers. And with that, we thought that we would give a chance to the PEPP to take off. unfortunately, our succession was not taken into account, supposedly because it was not, in line with the vision of the level one and the wish of the European Parliament. So, I'm not very optimistic because of this very low fee cap. And looking forward, I hope that indeed in the context of the first review of the fee cap, policymakers will accept to draw the conclusion on the basis of an assessment of the development of the market by that time and see what can be done to deal with this problem.
Thank you, Bernard. I had just one personal question when I'm listening to you. Is it a matter of principle or is it a matter of rate? Suppose for a moment the cap had been set at 1.5 as opposed to 1. Would you then be more pleased with the outcome? Maybe I could ask the market participants to react to that, Martin, Christian, on that blunt question. What would be your immediate reaction?
First of all, as you know, has been rightly said by Bernard, the main issue is coming from the fact that instead of having a kind of market assessment before finalizing this level 2 or level 1 regulation, it has been nearly done at the very end, so it's too late. I don't consider that it's good to set up a cap globally because by doing that, you, as Bernard mentioned, you have several drawbacks. I do believe in competition. I also do believe on the fact that if you have low fees, at the end of the day, you will have lower quality. And the PEPP is a unique opportunity to bring innovation to the pension market, life cycling strategies, but not only. So, and if you have innovation, I think from time to time, you have to accept to have a little bit higher fees because in fact, at the end, you provide much better value for money. So my advice would be on one side, make market assessment and follow the results. And second one, be flexible enough to allow innovation.
Okay, that's a fair statement. Thank you very much. We need to move on. The second topic I wanted to address with you is the tax aspect, the absence of tax harmonization on this on the PEPP. Clearly, in what you call the accumulation phase, that is when people are living through their professional lives. They may live in a number of different countries, and then in the decumulation phase, when they get the pension benefits, they may again be in another country, and during all these years, they will accumulate pension benefits which are subject to different tax treatments. In some of the countries, you will be taxed at entrance and not taxed at exit. In other countries, it is exactly the other way around. And that, in the context of a pan-European product which is aimed at the cross-border distribution, because if I'm not mistaken, there is a rule in the PEPP regulation which forces the PEPP provider to distribute the PEPP in at least 2 different jurisdictions and after some point in 3. How do we manage this incoherence in the different types of tax treatments which may occur, and what is the solution to that? Should I start with Martin to give a first view on this?
Thanks, Claude. I think there are 2 things to think about on this. Underlining all of this is the EU does not have formal tax competence for harmonizing tax rates for pensions products. So we have to work with the variety of national systems. But moving on from that point, how do we make sure that this complexity, this challenge, doesn't become a barrier to launch of products? And I think this is something where, as we're in Luxembourg, or virtually in Luxembourg today, this is something that the Luxembourg industry has focused on for many years. If you take the UCITS product has been distributed around all of Europe with different tax treatments of UCITS over the time. So solutions have been found in the past to tax treatments of products. So I think you get to two ecosystem issues. One, what's the pan-European ecosystem that you need to be able to manage these differing tax issues as efficiently as possible? And secondly, what's the national ecosystem? So Christian touched on this briefly in his introduction, and I'd just like to pick up on this on the national side. One is that the principle is that the PEPP should be taxed in the same way as an equivalent national third pillar pension product. That's a principle. In actual fact, those rules need to be incorporated into national rules, and service providers need that clarification from national tax authorities that the PEPP will be treated in this way. What are the filing requirements? What are the notification requirements? How does it run through? For example, although this is a personal pension product, what happens if there's a payroll reduction if the PEPP is offered as a workplace third pillar pension offer? A lot of questions that national member states need to clarify to service providers in order for this product to be able to run effectively. None of those are insurmountable with goodwill and a fair wind. Secondly, on the cross-border basis, Claude, you set out very well the challenge that we have different tax treatments, and you need to be able to monitor and map an individual's tax journey throughout their life. So they may start off with 10 years in Luxembourg, 10 years in France, 10 years in Germany, may want to retire in Spain. And so you have to be and each of those contribution periods leads potentially to a different tax treatment. So you have to be able to monitor that tax treatment and then stream the relevant tax payments or income payments appropriately and follow that through. That requires a lot of monitoring and processing power. Certainly there are innovations which can come through. We hear a lot about the use of DLT, of blockchain, about being able to do efficient tax streaming and tax monitoring, potentially by country-specific classes, as we may well have seen in UCITS, but there may be other ways, more efficient ways of doing that. But the more we get individual clarification from national tax authorities and national regimes, the more those technological innovations and solutions will come to the fore. But it's not going to be something that's going to be done in a year or 2 years. This will, I expect, be a progressive process, and will focus on key countries who say that they actually want a PEPP as part of their arsenal of savings products for their countries.
Thank you, Martin. Thanks. Very interesting. Christian, what could you add? What are the points where you would agree or disagree on Martin's previously made statements?
Thank you, Claude. First of all, I do agree with what Martin said. I just want to add a few things. First of all, we know that few member states could be keen to protect their local market. So it will be quite interesting to see if they follow the recommendation from the European Commission to grant to the PEPP the same tax framework as for local products. And why? Because we know that tax incentives are a strong motivation for subscription, a very strong one. A second remark I will make is, for the time being, these mobile workers, I would say, still represent only a single-digit percentage of the population in Europe. But as Martin said, in the next 30 to 40 years, and we deal with long-term horizon when we deal with pension, this could evolve. So we could also hope that there will be a little bit of simplification, because if you look at the regulation in details, it's very, very complex, and there could be tax frictions when you move from one country to another country. In that case, with low interest rates, you can end up with very low returns. So it's a big issue also on the net return side.
Mm-hmm. Fair enough, Christian. Bernard, I remember that EFAMA has produced a very good text paper on the treatment of the PEPP benefits in the various countries, which has highlighted how difficult it is to find a common denominator. What could you add from an EFAMA's perspective on this debate?
First, I'd like just to say I fully agree. I mean, with Martin and Christian, and in a sense also with your question. I mean, it's clear that the lack of tax harmonization will complicate the matters. But in fact, this problem, let the insurance industry to try to convince the European Commission not to make a proposal for the creation of the PEPP, saying, you need first to have tax harmonization and then a PEPP. And EFAMA has taken a different stance, I think positive one, to say, look, the problem, as Martin said, is not insurmountable, and solution will be developed over time. So let's have a regulation, and then let's see what could be the solution. And we could convince the European Commission precisely on the basis of the experience of the UCITS market, where there are different tax systems, different tax reporting obligation that fund managers have to deal with. And this has not prevented UCITS from becoming a great success, and Luxembourg to become the main domicile of cross-border UCITS. Now, this being said, I mean, along the line of the suggestions made by Martin, I mean, solution will have to come. I think they could come from the public sector. It would be great if the European Commission or EIOPA would create a database that would highlight the tax treatment applied to the PEPP in each member state, as well as all the requirements that needs to be fulfilled to get access to this tax incentive. These would avoid that PEPP providers would have just to collect this information on their own, and this would reduce the cost of the PEPP. For sure, this would open the PEPP to smaller providers. And another idea is that PEPP providers should be entitled to delegate some of the administration of these tax reporting to third party. And I hope that the experience there developed in Luxembourg in the UCITS market will indeed convince a number of firms to develop this type of solution. Last comment on the tax regime. A dream would be that, all countries for the PEPP would adopt the TEE regime. They would tax the contribution. And if it was done uniformly across Europe, in these cases, there would be no problem, because once the contribution have been paid, there is no any tax problem to deal with in the course of the life of the PEPP. And certainly this would increase the likelihood that the PEPP would become a truly portable pensions product.
Thank you. Thank you very much. Moving forward, I think that now that we've spoken so much about challenges and obstacles, it's always nice to try to stay positive. That is something in life which is always helping to solve issues, and we need to probably take a long-term perspective, as already some of you suggested in previous statements. And so I think we should try and spend a bit of time that, notwithstanding these immediate hurdles we cannot overcome because we have to live with them. The regulation is out and there is no hope that it will be changed anytime soon before a next assessment is made. But still, we have achieved something fantastic. You know, we've been dreaming of this end result. If we look back 10 years ago when the first PEPP or equivalent proposals were made at the levels of the industry, and no one would have thought that we could end up with a compromise, and here we have it, and that is very, very positive. So, looking about perspective, the first question I'd like to ask, maybe to our representatives of the market participants, is to say, EIOPA has published a survey after the level 2 regulation has been issued, and that survey is short but very straight to the point. It contains 2 questions to the industry participants. What are your plans now that you have a PEPP regulation, and what are the major obstacles you foresee in implementing this and creating and becoming a PEPP provider? And you know, I hope this question is appropriate, but I'd like to get some feeling from a sample of industry participants on what they believe is going to be the answer of a market participant. What are we going to do? Could we perhaps start with Martin and then get Christian to say a few words, and then I have a few other questions on the same in the same line.
I'd like to start with an initial comment of saying, how do we judge whether the PEPP is a success, and the time frame for judging that success? And that's not going to be in 1 or 2 years, and that's not going to be in the question of whether ourselves or Amundi or others of our competitors launch a PEPP or not within the next year or not. I don't think that's. I think we should be careful of that so as not to write the product off too quickly. And I'd like to draw a really sort of powerful analogy with the European Long-Term Investment Fund, the ELTIF. So Commission discussions came out in 2012, almost 10 years ago, about having an ELTIF, which is a parallel to the UCITS fund, which invests in long-term investments. They're still under 30 in the market. They're starting to come out. We have a couple of those, but it took us about 6 years from when we had the regulation to really work with distributors, build up the brand recognition, understand how we would do the product, and get it out there, for that really to become a realizable product and start. And we're still doing a lot of work on education in local markets with distributors on how this is valuable. I envisage that this is a similar sort of process for the PEPP, and sort of what are the conditions for success? I would say one of the key ones is financial capability and literacy at member state level. Because we know this is such a strategically important product for Europe's long-term effect, if we project ourselves forward to 2040, 2050, not having a viable third pillar product would really undermine the construction of individual financial resilience of capital markets union. So we need to get that wider ecosystem engaged on the PEPP to show, yes, this would be really valuable to have this in terms of for individuals planning for their long-term financial health, their long-term financial resilience. I'd also say one of the things, my second point, and then I'll quickly finish on what is a real benefit of the PEPP is the life cycling strategy in there. As we mentioned, in a number of countries, life cycling has been well established. The great advantage of life cycling is that it automatically adapts to an individual's journey through life. I think Bernard was talking about this. It starts off with a high equity allocation, and then the risk slowly evolves over time. But this happens without the individual having to have a lot of expensive discussions on reallocation. This is an automatic process, but it also means that suitability that you would often see in portfolio construction is inbuilt into product design. This is this is the first time we've had a European understanding of what are good outcomes in life cycling. So EIOPA doesn't tell us how to build a life cycling strategy. It tells us how to talk about a successful life cycling strategy. That is an incredibly important asset allocation. It is assets and investment opportunity. And it's something that we will use either in the PEPP, but we may well also use in collective solutions as we see the ongoing adoption of more DC style pension solutions. So the PEPP is a real catalyst for future change.
Okay.
So I'll finish there, and let's head over to Christian for his thoughts.
No, thank you, Martin. I would add, a few points. To come back to this very short survey launched by EIOPA. I would say the answers, the possible answers, are very straightforward, as Claude mentioned. It's yes, no, or undecided. For all reasons, long-term reasons that Martin just mentioned, I think, and we think, that it's quite difficult to have a clear-cut positive or negative answer at this stage. Because, first of all, the regulation will entry into force in 1 year. It will take time to really see how the market will start and evolve. So I think at this stage, we cannot say yes or no. We know that it's a major change, as has been said, and we obviously are looking forward to find, a possible solution for this very difficult economical equation that we mentioned at the beginning. So there are difficulties, but it's difficult to have a clear-cut answer. So it will be interesting to see the results, but my question mark will be, at this stage, if there are many, many undecided answers, it means that's too early to say what could be the outcomes, and that's a big issue. Why? Because the PEPP is heavily needed. There is a kind of urgency to provide long-term personal saving to European citizens. So there's kind of always a difficulty between market needs and the time of the implementing and the regulation. So it's always a big challenge.
Okay. Bernard, what do you think about this?
I would take an analogy with the UCITS. And as we all know, the success of UCITS was not immediate. It took time for the European fund industry and for Luxembourg to build its cross-border infrastructure. And investors also needed to discover and appreciate the quality of the UCITS brand. And over time, after, I would say, a test period, we all know that the demand for the supply of UCITS accelerated strongly. And based on this experience, I anticipate that the PEPP will also take some time to establish itself as a brand of personal pension, for sure. So there's a long time dimension to this question. But I have no doubt that the PEPP has a bright future ahead, because it is a product that meets the needs of the EU citizens today, especially in this very low interest rate environment, which is likely to stay with us for a long time. Now, for the PEPP to take off and to gain speed, in my view, and we kind of alluded to that already, there are two crucial conditions to be fulfilled. First, as Martin stressed, is that member state needs to give to the PEPP the most favorable tax treatment that is available to their national personal pensions product. And secondly, the structure of the fee cap will have to be reviewed, as well, the rules on the provision of advice to potential PEPP savers. Because if you think about the millennium, the recommendation to a millennium who would like to start saving in a basic PEPP should be straightforward. Should say start saving early, even in small amount. That's it. This is just a very basic, common sense recommendation. And I think that agreeing on principle like that would remove an important barrier to entering the PEPP market.
Thank you very much. Time is running out, and I would have liked to ask many more questions, which we can't. But I think I'm impressed by the powerful messages which I've been hearing from the three of you, which fills my heart with heat, because having been part of that PEPP project for many years, I think that we've achieved something exceptional, which was not taken for granted from the outset. And that is why I like your perspective to say that let's take a long run, let's look at it from a long-term perspective. Rome was not born in one day, and so is the PEPP not born in one day, but we have a good feeling, a good sound feeling. That is what I'm hearing from the three of you, that you believe in this as a long-term development, which is very, very important. And even if as a moderator you would always encourage your panelists to disagree, because that makes the discussion more lively, I'm very, very pleased that you've had the same conviction and the same messages in your own words, and I'm very pleased about that, if I may say so. Just as a 1-minute conclusion, could I ask each of you to leave one key message for 10 to 15 seconds max, where you would say, that is what I like the audience to take away from this session. Bernard, you start, please, and then Christian, and then Martin.
Thank you, Claude. I'm going to have a message for the members of the European Parliament and the organization representing the interest of European savers. You have got the 1% fee cap, but this will not be enough to convince consumers to save in a PEPP. We discussed that. So if you really want savers to benefit from the PEPP, you should convince the competent authority at national level to grant the same tax benefit to the PEPP. This is really necessary to get this level playing field between the PEPP and your products. And just to conclude, there is a strong argument to obtain a favorable decision. As you said, Claude, the PEPP is a higher quality product than most existing personal pensions product. So politically, it makes a lot of sense to create the condition for citizens to start saving in the PEPP.
Next one, Christian.
On my side, I will really stress, that for the first time ever, there is a common legal framework applicable in all member states for personal pension. So I do share what Bernard said. Let's make it happen. We know that there are difficulties, but let's make the needed changes. My second remark will be a little bit broader. You know that IORP2 is not a regulation, but it's a directive. This directive will be revised soon. And one of the objectives of this directive was to create the equivalent, in other words, a kind of pan-European occupational pension market. And it's heavily needed by large corporations because they are looking for more homogeneity and, as has been said, economies of scale. So let's take the opportunity of the PEPP, let's take the opportunity of this revision to make also happen a more pan-European occupational framework for these collective pension schemes.
Thank you. Martin. The final
Let's
word.
stick with it. Let's stick with it, with the real opportunity with the PEPP to create a product solution which will really enhance outcomes for European citizens and savers in the long term.
Thank you very much to the three of you for participating in this panel. I'm handing over back to Jonathan.
Thank you very much, Claude, Martin, Bernard, and Christian, for the very interesting panel and the salient points that you made. I think staying in the positive note that you did at the end, what really stuck with me is the fact that the PEPP is a long-term investment into Europe and European citizens. And just because we may not have a raft of PEPP products available next year, the year after, or even 5 years' time doesn't mean that it's failed. The important fact is actually that we've started and that we're strengthening that third pillar. I'd also like to take this time to thank Fausto for the points he made earlier in this session, as well as to the sponsor of today's event, PwC Luxembourg. And thank you to you, the audience, for joining us. Please don't hesitate to check out our website, luxembourgforfinance.com, for more information on our upcoming events, such as our China Finance Forum live stream that will take place on the 11th and 12th of May. We look forward to seeing you there. Have a pleasant rest of the day. Thank you. Goodbye.